Right, so welcome to this lesson on the trend retracement system. So this is the first strategy in this advanced course and one of the most powerful strategies because essentially we'll be trading with the trend. And so we're going to be buying or going long on stocks when their price is on an uptrend, as so, and going short on stocks when their price is on a downtrend, as so. So again, the question is, when is the best time to go long on an uptrend? And the best time is to buy when the price makes a dip on the uptrend, or a retracement, as you will. So on an uptrend, prices don't go up in a straight line every single day. They'll go through temporary retracements or dips. And those are the times we want to enter an uptrend. So you can see there's the uptrend, it makes a dip, uptrend, dip, and so on and so forth. So we'll be entering during one of the dips to capture the trend as it continues. Similarly, on a downtrend, we want to be going short or to sell, and we want to sell during a temporary rally on a downtrend. So a rally is a retracement on a downtrend. So that's the downtrend, that's the rally, which is temporary retracement, trend continues, rally, trend continues. So again, we won't be selling during the rally to just before the trend continues all the way down. So notice this is similar to the EMA bounce strategy you learned in level 1 of the basic course, with a few exceptions, a few differences. And the first difference is that in the EMA bounce, in the basic course, we had a fixed target price. So it was purely what is known as a swing trade. So we entered at the start of the impulsive wave with a fixed profit target to get out towards the end of the impulsive wave. For this system in level 2, we don't necessarily have a fixed target price. We aim to follow the trend as long as the trend continues. So this allows us to capture huge profits when we capture a strong trend. So we aim to exit the trade when the trend ends, which could take much longer with a lot bigger profits. The second difference is in this system, we're placing our stop loss slightly further away to give us more room and more buffer during price volatility. And finally, in this strategy, we'll also be introducing momentum indicators to enter when the momentum is in your favor to give you a stronger entry point in the system. So let's take a closer look at the two scenarios. And again, the first scenario would be buying the dip of an uptrend, okay, when we go long. So over the charts, you can see, how do we define an uptrend in the first place? So we define it by higher highs and higher lows. And we also define it by looking at the moving averages. So recall you've learned that when moving averages are in a sequence, from the smallest to the biggest, you have a very strong uptrend. So in this strategy, we'll be focusing on the 20 and 40 exponential moving averages, as well as the 50, 150, and 200 simple moving averages. So that is what also makes it different from the level 1 basic course, where it was all exponential moving averages. So we use all EMAs in a basic course for a very short-term swing trade. But for a trend following system where we give more buffer and more room for growth, we tend to use simple moving averages for the 50, 150, and 200. But we still maintain the exponential moving averages for the 20 and 40, which is the shorter term moving average. So these are the moving averages we'll be using in this system. And again, we'll be buying or going long when the price finds support at the moving averages, at one of the moving averages. So we want the price to be making a dip and bouncing off either the 50, the 100, the 150, or the 200 simple moving average. So as long as the price hits one of these moving averages, that is our cue for potential buy entry. So in this case, you can see that the price dips and finds support at the blue line, which is the 50 moving average. Now, what is really important is before we enter, we want to ensure that recently that moving average has been tested to be a strong support. So in other words, it bounces off the 50. We want to buy only if the 50 has been tested before. Similarly, if the price bounces off the 150, which is the green line, so sometimes it may bounce off the 150, we will only buy if the 150 has been tested before to be a strong support. So essentially, that's when we go long. On the opposite side, we go short on a downtrend. And again, we go short during the rally on a downtrend when the price has a temporary rally and finds resistance at one of the moving averages. So again, ideal resistance is either at the 50, 100, 150 or 200 simple moving average. Again, the moving averages are the same. Recall the downtrend, we've got a clear moving average sequence from the biggest moving average to the smallest moving average, right? We have got the 200 on top, the 150, the 50, the 40 and the 20. All in sequence, we've got lower highs and lower lows. So over here, the price rallies up and you can see it's hitting the resistance at the 50 moving average. So once it hits that resistance and it turns down, we want to go short. We want to sell just before the trend continues down. And again, we will only enter if that moving average in question has been recently tested before. Boom, boom, and we enter. Similarly, if the price retraces to the 150 and bounces, we will go short only if the 150 has been tested before. So a prior test is really important to give us confidence that this resistance will hold and the downtrend will continue. So this is a quick review of how to set up the chart specifically for this strategy. So I'm using the Think or Swim software from TD Ameritrade. Again, you can use any charting software you want. All charting softwares have basically the same kind of indicators and moving averages. So the first thing I'm going to do is I'm going to put in the moving averages we're going to use for this system. And as I mentioned, it's going to be the 20 and 40 exponential moving average. So we're going to go to studies over here. And we're going to put in the exponential moving average. And click on that. And click again. So we're going to have two EMAs. And the first one would be the 20 EMA. We're going to use red for that. And the second would be the 40 EMA. So 40. I'm going to use blue for that. Right. So again, we've got the 20 exponential and 40 exponential moving averages. Next, we're going to put in the simple moving averages. So you could put in the 50, the 100, the 150, and the 200. You can put in 4 simple moving averages. So we're going to go to simple moving average. So click once, click twice, 3, 4. There we go. Okay. So again, the first one would be the 50. And again, we're going to use blue, but to distinguish it from the 40, we're going to put a bigger width. So it's a thicker line. You can put number 2 in terms of width. So we can distinguish it. Next would be the 150. Click on that to edit. It's really green, so just put it number 2, so it's a thicker line. Okay. Next would be, again, click on this widget. 200, sorry, oh, we forgot the 100. So let's put 100. 100, we can use orange. 2. All right, so we've got a 50, 150, 100, and finally the 200 simple moving average. Put red and 2. Okay, great. So we've got all your moving averages all there. Now, besides that, we're going to put in what is known as momentum indicators to help us to determine when the price has bullish or bearish momentum. And there are 3 momentum indicators we can use. First would be the MACD. So you could choose MACD or MACD histogram. It's the same thing. It's how it's represented. So you can use MACD. So I'm going to click on MACD. And for MACD, in this strategy, we'll be using the default setting of 12, 26, and 9. Right? 12, 26, and 9. So we're going to keep it there. Next, we're going to put in force index. Force index. And again, these indicators are available on any charting software. Whichever you use, these are standard indicators. So double click on that. And for force index, we'll be using the default 13-day average for the force index. Finally, we'll be putting in the parabolic SAR. Okay. Here we go. The parabolic SAR. And it did not go in. Let me click on that again. Oh, there we go. Oh, sorry, it's already there. Let me cancel that. Okay. So the parabolic SAR, let me edit it a bit. I like to see it in black, personally, right? Not in red, black. Okay, so once it's all there, we've got all the indicators. You can save your study set. You can click Save. And you can call it trend retracement. Here we go. So once it's there, click OK, and you can see all the indicators are in. Looks a bit messy, as you can see. No worries. Let's zoom into the 1-year chart, and it's a bit clearer over there. Okay, I can always zoom in over there. Okay, so what you're seeing is, again, this red line. There's a 20 EMA. That's the 40. That's the 50, the 100, the 150, and the 200. Okay, so we'll be going through the specific rules on a clear uptrend in a while, right? So basically, on a clear uptrend, the 20 should be above the 40, and the 50 should be above the 150, and the rest of the moving averages are basically there to as support level. So when it bounces off the support level, we know it could be a time to enter. Next, we've got the MACD. So over here, you can see we've got the MACD, moving average convergence divergence, and this was covered in the basic course under indicators, under technical analysis. So we have covered this before, but I'll do a quick recap on how to read the MACD line. Next, the force index. So I've not spoken much about the force index. I'll explain it in a while. And finally, the parabolic SAR, right? So you can see these dots over here, the black dots. These are the parabolic SAR. So a quick recap from the basic level 1 course on how to read these indicators. Now before that, I'm going to change some of the colors to my favorite colors. So first, I'm going to look at the MACD. As you can see, there's a green and purple line, which I don't like the colors. I'm going to change it. So I'm going to go to the studies. Now magic portion, go to MACD. Over here, I'm going to click on edit. Alright, so what I'm going to edit is I'm going to change the value of the MACD line to black. Okay, so the MACD line will be black. So again, there are two lines, the MACD line and the signal line. Alright, so the MACD line will be black, and the signal line, which is the moving average of the MACD line, will be red. Alright, so put it there. Okay. For force index, again, I'm going to just change the color because I'm used to the black. I like black, so I'm going to change to black. For the force index, click OK, and I'm going to save it again. Save it. Already saved it. Trend retracement. Yes, I want to replace that. Good, we're good to go. Great. So again, how do you read these indicators? Now, let me begin with the parabolic SAR or parabolic SAR. So these are the dots that you see over here. So basically, when the dots are below the candles, it tells you that momentum is bullish. So that's bullish momentum. And when the dots are above the candle, it is bearish, right? So you can see bullish, 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 bearish, bullish, right? So you can see it's pretty sensitive, right? It goes bullish and bearish quite quickly. So what it's telling you is that within this entire uptrend, there are times when momentum is bullish and momentum is bearish. So although this is an uptrend, but this is a bearish momentum, on that uptrend, and there's a bullish momentum over there. So essentially, when we go long, ideally we want to have as much bullish momentum as we can. And I'll talk about when we will use these indicators, right? So just understand how they work. Next would be the MACD. So for MACD, you've got two lines, the black line, which is the MACD line, and the red line, which is the signal line. And again, we've learned this before in level 1, but let me just revise that. So basically, again, when the black line is below the red line, that means momentum is bearish, okay? And it shows from the red histogram, right? And when it crosses, histogram turns red, okay? Now, when the black line, MACD line, crosses above the signal line, the histogram turns green, and that's bullish momentum. So that's, again, that's bullish, that's bearish. So again, it's really sensitive. It goes through bullish and bearish momentum during the overall uptrend. Finally, we've got the force index. Now, force index is an indicator that measures the volume, the strength of the force, which is measured by volume. So essentially, when volume is high, the force index is stronger. When volume is low, it is weaker. And what we want to see is when the force index is above this red line, the red line is the baseline, right? So when it's above the red line, it's bullish momentum with strong volume. And when it's below the red line, it is bearish momentum, okay? So how do we use these indicators? We'll run through that in a while under the entry rule. So just understand how they work right now. Parabolic SAR, below candle bullish, above candle bearish. MACD, when you have the green histogram, bullish, red histogram, bearish. Force index, above red line, bullish, especially if it's rising. Below red line, bearish. That's all you need to know for now, and how to set up the charts. So besides these indicators, we'll also be looking at relative strength whenever we go long on a stock or go short on a stock, and we'll cover that in the later lessons. But for now, let me show you how you can find it on the platform. And again, this is available on most charting software, TC2000, Thinkorswim. So go on to your studies and look for relative strength. There you go, that's the one, relative strength. Click on that. And we have it over here, relative strength. Now, bear in mind, this is not RSI. RSI stands for Relative Strength Index, which is something completely different. This refers to relative strength of the stock compared to the S&P 500. So we are basically seeing how strong the stock is compared to the rest of the market. So that's what's key about this indicator. So click on that, and there you go. So over here, as you can see, this is the relative strength of this stock versus the S&P 500. So this blue line represents the relative strength, and this red line at the bottom over here is the baseline. So basically, when this blue line is above the red line, it tells you that this stock is stronger than the rest of the market. If the blue line is below the baseline, this stock is weaker than the rest of the market. And later, I'll be talking about when we go long, whatever strategy that we use, breakout or retracement, we only want to go long when the relative strength is stronger than the rest of the market. So we want a blue line to be above the baseline, and it should be trending upwards, like so. At the same time, when you want to go short on a stock, regardless of the strategy, we want to go short on stocks with weak relative strength. In other words, this blue line is below the baseline and it's falling, so that's weak relative strength. So again, more on that later on. Let's now move on to the specific entry rules for longs and shorts. So now you're clear on how to set up the charts. Let's take a look at the specific long setup rules for going long, which is basically the dip on the uptrend. So the first thing is to always look at the S&P 500. So a rising tide lifts all boats, recall that. So if you're trading the US market, always look at the leader, and the leader is the S&P 500. So when the S&P 500 is bullish, you find that most stocks tend to go up. So it makes sense to go long when the S&P 500 is bullish. So there's a high likelihood that whatever stock you trade, the chance of going up is a lot higher. So we want the S&P to be bullish when we are taking long trades. How do we measure that? We want the S&P to be above the 20 EMA, and ideally when the 20 EMA is above the 50 moving average. So that gives us a very strong bullish market and the ideal time to take long trades. Next, on the specific stock we're trading. So in this case, for example, we're looking at Adobe on this chart. We want to see the price on a very, very clear uptrend, making higher highs and higher lows. So as you can see, the price is making higher highs and higher lows. So we're going to see that uptrend pattern. Next, we want the moving averages to be in a very, very clear sequence. So the 20 EMA has to be above the 40 EMA, right? So this over here, the 20 red line above the 40 blue line. And we want the 50 moving average, simple moving average, to be above the 150 simple moving average, which is basically this thick blue line above the thick green line. Now, if this condition is not true, we can also take it if the price is above the 200 moving average and the 200 MA is sloping upwards. So in other words, if the price is above this red line, with the red line sloping up, that is also a valid setup. So either or condition must be met between these two, but 20 must be above the 40. Next, we are waiting for a time when the price retraces, dips, and bounces off one of the moving averages that acts as a support. So either the 50, the 100, the 150, or the 200 simple moving average. What's important is to ensure that the moving average support has been recently tested to be strong. So again, if it bounces off the 50, we want to see the 50 being tested recently. If it bounces off the 100 must have been tested recently as well. Now, as the price is bouncing off the moving average, when is the best time to enter? We want to wait for a bullish candle to appear following a pivot point. Now, so what's a pivot point? Let me attempt to explain right now. So again, let me do some drawing. So let's imagine this is the moving average. That's 50, for example. And the price is bouncing off. So it's been tested before, right? And the price is going down right now. So price going down, going down, going down, right? So it's gonna hit the 50. Say it hits it over here. Now, after it hits the 50, we want to see a bullish candle that appears right after a pivot point. Now, how do you define a pivot point? A pivot point is one where it's made up of 3 candles, like so. Candle 1, candle 2, and candle 3. Okay, there we go. So this is known as a pivot point, this over here. Why? Because this low is lower than the previous low and lower than the next low. So it creates a V shape. So a pivot point is basically a V shape. Make sense? So over here, for example, this is a pivot point because this low is lower than this low and lower than the next low. Now, is this a pivot point? This one? Yes, it is. It is also a pivot point. That's a pivot point as well. Okay, this is a pivot point. As you can see, this low is lower than that low and the next low. So basically, we're looking for V shapes, right? And that's a pivot point. This is also a pivot point over there, and so on and so forth. So what we're going to see is we're going to see the price hitting the moving average, creating a pivot point, and we can enter the moment we see a bullish candle appearing right after the pivot point. So this has to be a bullish candle. So if it's a bearish candle, then we wait for a bullish candle to appear. So for example, if this is a bearish candle over there, we'll say, okay, let's wait a while. And let's wait for a bullish candle to appear after the pivot point. So the moment a bullish candle appears after a pivot point, we could take that entry. So it tells us that, hey, it's bounced, it's going up. Now, you've learned candlestick patterns in the level 1 basic course. Now, there doesn't have to be a requirement for a specific candlestick pattern in this strategy. But if you have a candlestick pattern like a bullish pin bar or a bullish engulfing pattern, that's a bonus. It's a bonus, okay? Now, the other thing is we only want to go long when we have got at least one out of the 3 momentum indicators flashing a bullish signal. Recall there are 3 indicators: the parabolic SAR, the dots, the force index, and the MACD. Now, as long as one of them shows a bullish signal, that's good enough to go long. So that tells you that, hey, the price is starting to move up after retracing. So let's take a closer look at the charts and let's take a look at how the rules are met. So again, what's the first rule? First rule will be S&P is on an uptrend. So you can check out the S&P. Next, we want to make sure that the stock is on a clear uptrend. So in this case, we're looking at Adobe and we see a very clear uptrend because again, the 20 EMA is above the 40 EMA and the 50 moving average is above the 150 moving average. So that all checks out. Next, we want to see the price making a dip and finding support at one of the moving averages, the 50, 100, 150 or 200. So in this case, which moving average is it finding support at? It's the 50, the blue line. Okay, so over here, let's take a look at this one over here. So you can see the price goes down and hits the 50 moving average, and that is what is known as a pivot point. So what's important is to check, has this moving average been tested before? Yes, over here you can see it's been tested before. If it has not, we will not take the trade. Similarly, if you would like to take this trade as it bounces off, has it been tested before? So it has been tested over here, tested over here, and tested over here. So it has to be tested at least once prior to your entry on the support. Next, we're waiting for the first bullish candle to appear after the pivot point. So let me zoom in over here and let's take a look. So this is a pivot point and this is a bullish candle. Can you see that? Okay. Now, question is, can we enter right after this candle closes? And the answer is strictly no. Why? Because notice that the moving averages, or rather, notice that among the 3 momentum indicators, neither of them are bullish yet. They are bearish, right? So at this point, notice the parabolic SAR is bearish. The force index is still bearish. And MACD is still bearish. So again, we want to wait for one of them to turn bullish. Now, when does it turn bullish? Over here. And that's why I indicate this as the long setup has been fulfilled. At this bullish candle, notice that the parabolic side is still bearish, right? But notice the force index has crossed bullish above the red baseline. The MACD is has just turned bullish as well, right? So we have got the force index and the MACD both showing bullish momentum, and this is still bearish. So like I mentioned, as long as one out of 3 is bullish, that validates the setup. So force index is all we need, and that's the setup. Now, in addition, notice that this pattern over here, what candlestick pattern do we call that? That's right, it's a bullish engulfing pattern. A bullish engulfing is one with a red candle engulfed by a bullish white candle. So that's an engulfing pattern, which also gives us a bonus that this is a strong reversal pattern. So this is a valid time to go long, and this validates the setup. Now, let me ask you a question. Would this have been a valid setup again? Well, this is a bullish pin bar, which is a bonus, but again, none of the indicators are bullish, so it's a bit more risky to take the trade over here. Could we take the trade over here, for example? Would this have been an entry point? So again, that's a pivot point. It's been tested before. So we can say, okay, that's a valid support. That's the first bullish candle that appears. But again, you can see the indicators are still bearish, bearish and bearish. So you only take the trade probably after this candle closes. So when this candle closes, there's a bullish candle. And you can see it's bullish over there. It's bullish. So we've got momentum indicators bullish. We could have entered after this candle as well. So this could have been a valid entry. That's a valid entry over there. Now over here, you can see that this turned bullish. And so this could have been a valid entry here as well. So these would have been the valid entry points on this uptrend setup. So once we've got all the long setup conditions met, we can place our buy order, our stop loss, and if you want to, a profit target as well. So let's run through the specific entry rules. So we can place a buy stop limit order 1 to 10 cents above the high of that bullish candle. So if you zoom in, this is what it looks like. So we mentioned earlier that this bullish candle would be the candle that confirms the long entry. So what we could do is we can put a buy stop limit order just a few cents above the high of this candle. Now I've mentioned this in level 1 of the course about, it depends on the price of the candle, right? So for example, the price of the stock is less than $5. You could put the buy order 1 cent above the high of the last candle. If the stock's price is between $5 to $10, you could use 2 cents. If it's $10 to $50, you could use 3 cents. And if it's between $50 to $100, you could use 5 cents. And above $100, you could use 10 cents or more. So that's just a rough guide. All right, so again, this stock happens to be a $200 stock. So we could place the buy order 10 cents or even 20 cents above the high of the last bullish candle. So the next day, if the price exceeds the high, it would trigger our buy order and we're in the trade. Now, there are exceptions to this rule. If the bullish candle happens to be really big, like got a really big bullish candle like that, then I would not buy at the high of the candle because I'll be entering at too high a price, too far from the moving average. Remember, when you enter, you want to enter when it's not too far from the moving average. So in this case, I could skip the trade, or if I want to take the trade, instead of using a buy stop order, I'll use a buy limit order, which means I want to buy lower than the current price, which means I like to wait for the price to probably retrace to 50% of the long candle and buy at a lower price. Now we can use this for this strategy because we already have confirmation from one of the momentum indicators, because the momentum indicator is showing us a bullish momentum, so we can afford to enter at a slight retracement if the bullish candle is really big. So that's an exception to this rule. That's slightly different from the EMA bounce in level 1, where there was no momentum indicator to confirm momentum, so we had to buy only at the high of the bullish candle. Next, where do we put our stop loss? Now I mentioned that for this strategy, our stop loss we place slightly further away to give us more buffer for volatility. So in this strategy, we'll place our stop loss below the moving average by 1 ATR. So our stop loss would be 1 ATR below the moving average support. Now recall in, again, the basic course, you have learned what ATR means. ATR stands for the average true range of the stock. So ATR basically tells you what's the average volatility of the stock, how much the stock moves in a given day. So we always want to give some buffer. So I'll show you again how to measure ATR in a short while. Using the charts and using Finviz, you can measure the ATR. So for example, in this case, the ATR is about $1.50, for example. So what we do is we'll place our stop loss $1.50 below the moving average. So that's our stop loss. So the distance from the buy entry to the stop loss, that'll be known as 1R. So recall what 1R means. R represents your risk, which is the risk per share or the risk distance. Now, also take note that your stop loss should also be below the recent swing low, whichever is lower. Okay, let me repeat that once again. So your stop loss has to be 1 ATR below the moving average, correct? Or below the recent swing low. Now this is the recent swing low, the one that bounced off the moving average, right? So it's got to be 1 ATR below the moving average or below the recent swing low, whichever is lower. Whichever is lower. So in this case, this stop loss is below that, that's fine. Okay, so that's our stop loss over there. Now, as I mentioned earlier, you can choose to place a fixed target price of 2R, which means if you're risking, for example, $6, for example, your profit target would be at $12. Or you can choose not to place a profit target for this strategy and simply stay in the trade as long as the trend is moving up. And we only exit the trade when the downtrend is confirmed, when the 20 EMA crosses below the 40 EMA. So let's take a closer look at how this setup works. So again, on my left, you can see our buy order is at, for example, 59.52, right above the high of that bullish candle, which we identified as the valid setup. We place our stop loss, in this case, 1 ATR below the moving average. So our stop loss would be at $56. And again, I'll show you in a short while again how to calculate that ATR in case you've forgotten from the basic course. But the point is to understand why do we place our stop loss at a distance below the moving average is to give buffer. Because at times, notice when the price hits the moving average, it doesn't always touch it and go. Sometimes it may pierce it by a fair amount like that, right? So it breaks slightly below, goes up again. So you're going to give a bit of buffer. And so the buffer we use would be 1 ATR in this case. So again, to give room for volatility. So if you take 59.52 minus 56, your risk per share or your 1 hour distance is 3.52 in this case. So again, if you want to place a profit target, place the profit target at 2R. So 3.52 multiplied by 2, it's 705. So 705 plus 59.52, our take profit would be at this level over here, 66.57. So again, if you enter the trade over there, you would take profit over there and you get a 2R win. So that's one way to trade this strategy. Or, like I mentioned earlier, if you do not want to place a fixed target price, you could exit the trade when the 20 EMA crosses below the 40 EMA, which means instead of having a profit target, you stay in the trade until the short-term trend is confirmed. So over here, you can see the 20 EMA crossing below the 40 EMA, and you would exit somewhere there over here. So in this case, you can see that taking the profit target would have gotten a better result than exiting when the moving averages cross down in this particular case, because it was a very sharp drop. So that can happen at times. However, there are cases when if you catch a strong trend, staying in the trend will be a lot more profitable than exiting at 2R. So there are pros and cons to this approach. So let me show you an example of one with a very strong trend. So over here, you can see it's a soda. And like I mentioned, trend following without a target price can lead to huge profits when a strong trend is caught. And again, you never know when it's going to happen until it happens. All right. So in this case, you can see, let me just zoom in over here. You would enter the trade as it bounces off the moving average. You enter over there, the stop loss over there. So in this case, your 1R would be 350. And once you enter the trade, notice that you would have ridden the trade all the way and exited over here when the 20 crossed below the 40. And that's when the downtrend started, right? So by exiting over there, you can see that your profit would have been 26.98 out of a risk of 350. That would have given you a 7.8R win. So that's again the advantage of following the trend without a specific stop loss. But I'll also show you how you can protect your profits along the way. So as it's trending up, you want to raise your stop loss to protect your profits in case you get a sharp drop. Your profits are protected. But let me go through that again in a short while. Now, over here, it says this. Your stop loss can be raised to the entry price and below subsequent pivot points to protect profits as well. So what this means is once you enter a trade and you place a stop loss, so that is your 1R distance. The moment the price moves by 1R in your favor, you can move your stop loss to the entry price. So the worst that can happen is a break-even trade. The price comes back down, hits the stop loss, you've got a risk-free trade. All right. So again, let me mention that again. Once the price moves 1R in your favor, you can then shift your stop loss to the entry price. So you've got a risk-free trade. Subsequently, as the price goes up and you're following the trend, you can raise your stop loss to below subsequent pivot points to protect your profits. Okay, so basically what it means is you're entering over here, your stop loss is over here, right? And the moment the price moves by 352, so it moves up somewhere here, okay, you can then shift your stop loss to your entry point. So now your stop loss is at your entry point, you've got a risk-free trade. Subsequently, as the price goes up and hits the moving average again, bounces off, what can you do? That's right, shift your stop loss to below that swing low or pivot point. It goes up again, it hits the moving average, bounces off. What do? Shift your stop loss below that pivot point again. Goes up, hits the moving average, bounces off. So you keep shifting your stop loss to below the subsequent pivot points. All right, so the stop loss will be shifted over there, over there, over there. And finally, over here, you can see that it hits the stop loss and you get stopped out over there. And you would have locked in all the profits you made from the entry point to the exit point. So that can be done as well. So in this case, you can see, again, you would enter over there. All right, price goes up. What can you do? Shift your stop loss to entry, protect your trade. As it goes up, keep shifting your stop loss to below the pivot points that bounce off the moving average. Okay, you can shift it over there, you can shift it over there, and you get stopped out over there. And you would have captured your whole profit. Another option would be you could enter the trade and you could take half your profits at a 2R target price, and for the other half, you could let it run and exit only when the 20 crosses below the 40. So there are many ways in which you could exit this trade depending on your style, depending on what you prefer. And there are pros and cons to both approaches. So let's take a closer look at the entry point for this particular trade on soda, and let's see if you can identify where was the valid setup. And over here, I kind of like zoomed into it. Again, this is soda, and that's the same trade, but I've zoomed in so you can take a closer look at when would have been a legitimate time to enter the trade. All right, so over here, you can see the price going down and bouncing off the 50 moving average, okay, and creating a pivot point. So again, that's a pivot point. And when would you enter the trade? Would you enter the trade at this red candle? Yes or no? No, because remember, we have to wait for the first bullish candle to appear after the pivot point. So how about this one? Would we enter on this bullish candle? Well, let's check. We need to have one of the momentum indicators to be bullish. The parabolic SAR, which are the dots, is still bearish, so that's a no-no. A MACD is still bearish, that's a no-no, but you can see that the force index has already crossed bullish slightly, so we've got 1 out of 3 conditions met. So this means this close of the candle would be a valid entry point. So where would we place our buy order? Again, we could place the buy order right above the high of this candle, in this case 59.52, and we place a stop loss 1 ATR, and again you have to calculate the ATR, 1 ATR below this moving average support. In this case, the stop loss would be at $56. So we are buying at 59.52, stop loss at 56. What's the difference? The difference would be 350. That is known as our 1 hour difference. So again, our target price would be $7, or you could follow the trend without a profit target and exit when the 20 crosses below the 40. So notice again, in this particular case, following the trend would have been a lot more profitable than taking profit at 2R, which would be somewhere here. Okay, so like I mentioned, there are pros and cons to both approach. If you have a fixed target price, the pro is that you get out at 2R, you move on to the next trade. But the con is you miss out when you catch a strong trend. If you don't have a profit target, the pro is you can capture really big profits when you catch a strong trend. But if the trend doesn't last, you could end up with less profits. So another approach would be a hybrid approach, which I mentioned, which would be when you enter an order, you could divide into half. So half your order, you take profit at 2R, and the other half of the order, leave it and let it run and take profits only when the 20 crosses below the 40. And that would be one that has the best of both worlds, if you will. All right, so for those of you who have forgotten how to calculate the ATR, let me just revise it really quickly with you guys. So I'm looking at the stock data, DATA, and I noticed that it's bouncing off the 50 moving average over there. You can see it's bouncing off, boom, and it's been tested before, so that looks like a legitimate bounce. The force index, you can see, is bullish, just crossed bullish over there. And the parabolic SAR is also showing a bullish signal. All right, so let's imagine you like to take this trade. So where would you put a stop loss? 1 ATR below the moving average. So again, how do you calculate ATR? There are 2 ways to do it. One way is to go to your indicator. And again, you can do it for any software. Look for ATR, or average true range, right? Click on that. Let me just remove the other indicators so it's not too messy. Just get rid of the rest of them. Okay, so by default, the ATR is 14 days, so you can keep that. And okay, there you go. All right, so what you're seeing is the average range of the stock price in the last 3 months. Now we like to look at it in the last 3 months, so select 3-month daily candles, right? So again, this is 3 months, and that's the ATR. So usually what I do is I take the average ATR of the last 3 months. So what does it mean? You can see there's the top, there's the bottom, right? So I roughly take the center. So it's not It doesn't have to be exactly precise, but somewhere at the center, that's the ATR one, which would be roughly over here. I'll put my top, bottom, center, so roughly somewhere over there. Yeah. So I'm going to zoom in. So what's the ATR? $5. Roughly it's $5. So this tells you that this stock moves an average of $5 in a day. That's the average volatility. So where would I put my stop loss? I'll put my stop loss at the moving average minus $5. So in this case, the moving average is at, where is it right now? It's at roughly 119.95. Can you see that? Or, well, no, it's 118.9. All right, so 118.9 minus $5, that's 113.9. So in other words, my stop loss would be at 113.9. Somewhere over there. There we go. All right. So if I intend to buy over there. Now, this was actually a valid trigger candle. So you could actually have bought it right after this because, you know, it's bullish and it's a bullish candle. So you could have bought it over there. So this would be my buy order. This would be my stop loss. And again, the stop loss must be below the recent pivot point, which would have been the bounce over here. Boom. Can you see the bounce? Okay, so there's a pivot point, pivot point, pivot point, pivot point. So the stop loss must be below the most recent pivot, which it is, so that's fine. All right, so that would be my 1 hour distance. There we go. All right, so understand how to calculate ATR right now. Now there's another way, which is the lazy way. And a lazy way is to just go to FinViz. All right, go to FinViz and just put in the ticker symbol that you're looking for. In this case, it's data. And right below, they've got the ATR. There we go. Which is 489, which is pretty close to $5. So it doesn't have to be exact. It's somewhere that's fine, right? So you could just look at the ATR on FinViz or calculate it yourself manually using the charts. Last 3 months, take the average ATR. Right, so now you understand the dip on the uptrend setup. The next thing is to understand that you can't apply this on any kind of stock that you see. So one of the mistakes that people make is they learn a setup and they apply it on the wrong kind of stocks. And they say, hey, how come my win rate is not as good as it should be? So you should only apply it on certain kind of stocks. Remember, not all stocks are tradable. Only certain kind of stocks are tradable. So what are the best stocks to trade? Well, I mentioned before, we want to trade stocks going long only when they've got strong relative strength. And I showed you earlier the relative strength indicator should be rising above the baseline. At the same time, we're going to be learning about shorting as well, selling. You're going to go short with weak relative strength. When the relative strength is below the baseline and falling. That's the first thing to understand. Next thing, we only want to trade stocks with sufficient volume. We're looking for high average volume of at least 150,000 shares traded per day. And again, you can check the volume on FinViz or most other websites as well. But most importantly, we only trade stocks that respect their moving averages. Not all stocks do that. Like, notice this stock over here, it's respecting the moving average, right? Every time it goes to the moving average, it bounces off, bounces off, bounces off. So we call this stocks that are tradable. On the other hand, look at this kind of stock. Look at that. Look at the pattern. It's really choppy, right? So it doesn't respect the moving average. You can't trade these kind of stocks. They are not tradable. Another example would be this one. Let's take a look. This one's not tradable because, again, it doesn't respect the moving average and there are many gaps. So avoid stocks with a lot of gaps at the center, right? When there are a lot of gaps and broken candles. So respect moving averages, few price gaps. And again, we're looking for predictable, repeatable price patterns. So this is a very, very clear pattern that can be traded on the upside. This is a clear pattern that can be traded on the downside. These are erratic, choppy patterns that can't be traded. So now you know what kind of stocks we're looking for. How do we find these stocks every single day? So I'm going to go into screening for these stocks right now.